I want to talk about what happened over the weekend, right? We saw a bunch of central banks, to be specific, the U.S. central bank, the Federal Reserve, the Bank of Canada, Bank of England, Bank of Japan, the ECB, and the Swiss National Bank. They made a joint statement. Kaylin, please correct me if you think I'm wrong, but I don't remember that in recent history at all. I don't think I've ever seen this before.
Well, no, the global central banks will coordinate. They oftentimes don't announce it like that. But there was a lot of cooperation and coordination, especially dating back to the 2008 financial crisis. What's different about this is that after the 2008 financial crisis, the Fed left open what's called swap lines, foreign exchange swap lines with other central banks. And for the most part, they've just been dormant. But they obviously have they've started them up again in a big way. And it will be fascinating to look at the impact of that on the Fed's balance sheet. I tweeted that I came from Credit Suisse. I spent 10 years at Credit Suisse, and I worked for almost a year directly for the co-CEOs of Credit Suisse in 2001 to 2002, so just over 20 years ago. And it was back at a time when Credit Suisse almost failed. And I remember at the time talking to the team who was advising the parent company. I was working on the restructuring of the insurance subsidiary that imploded at the time. But I was in Zurich at the headquarters in Paradeplatz, and talking to the team that was dealing with the Swiss government on the recapitalization of the company. The stock had gone from 90 to 19 at that point in time. And it was right after the 2001 stock market crash, 9/11, et cetera, just to paint the picture. And long story short, here's the punchline. We figured out that if Credit Suisse ever went under, it was going to be a gift, being sarcastic there, to the Federal Reserve, because the Swiss National Bank couldn't possibly expand its balance sheet big enough to bail out Credit Suisse. It was that much bigger than the Swiss economy. And so most of its exposure was US dollars. So basically it was going to end up being the Fed's problem, not just the Swiss National Bank's problem. And through these foreign exchange swap lines, I think we're going to see that that's exactly what will have happened. The Swiss economy and the Swiss currency, the Swiss franc, is just simply not big enough. It's a fraction of the size of the euro area, a fraction of the size of the U.S. And as a result, when you get a bank that big that dwarfs the entire economy of its home country, when it goes under, it's going to be felt around the world, and all the central banks are going to end up having a problem, most especially the Fed.
So was it a bailout? What really happened here? And then before we get to that, could you explain in layman terms what swap lines are for everybody?
Yeah, so it's essentially a way for US dollar funding to make it to offshore banks. So Credit Suisse has a big US operation. In fact, they have a New York branch of the Swiss bank that is what's called a primary dealer. It's one of the couple dozen large banks that is required to buy and does partake in every US Treasury auction. So when the US government issues debt, they do it through the US Treasury, but they actually do it through what's called the primary dealers. They are the biggest banks in the world, and Credit Suisse was one of those. UBS is as well, by the way. But all the big banks are primary dealers. It gives you an advantage because you get access to that newly issued collateral, which is extremely valuable in financial markets. So what happens in a foreign exchange swap is that a central bank can pledge US Treasury collateral in exchange for US dollars. And so if there's a shortage of US dollars in the Eurozone, the ECB, the European Central Bank, can take US treasuries and pledge that as collateral for an overnight loan, effectively, in US dollars. So the dollars make their way to Europe. And I think that's going to be the method. Eventually the Bank for International Settlements will publish a heat map that shows the directional flows. And they did that after the 2008 financial crisis. It was extremely interesting because the Fed's balance sheet expanded from 800 billion to about 3 trillion during the 2008 financial crisis. Last I looked, it's 8.4 trillion now, after having been brought down from a peak of just under 10 trillion. But that gives you a sense of the numbers here. And the punchline is that in 2008, the bulk of the flows, the bulk of that expansion from 800 billion to 3 trillion back in 2008 on the Fed's balance sheet went to foreign banks. It was an offshore shortage of US dollars. And I think that's going to end up happening here again, potentially.
So, and then was this a bailout?
Yeah.
And I have, for our video listeners, I have the Fed balance sheet pulled up and what Caitlin was describing, right? Just, it literally looks like a hockey stick up. It just keeps going.
Yeah, of course it's a bailout, right? I mean, these are backstop facilities. If the banks were solvent, they wouldn't need the backstop facilities. Now, a lot of people will debate because, this is temporary liquidity. It's a loan. It's not an asset that's going on. The Fed's not buying the actual treasuries, which would be technically QE, but it's backdoor QE.